But let's talk about what's happening with the tyre sector and whether that's been poised for an upcycle. What's the impact of the rising COVID cases? What with the soaring RM costs as well? Let's take stock of all of that with Arnab Banerjee, the COO at CEAT, joining in on the show right now. Arnab, hi, good morning. Great to have you on the show. You know, same time last year, Arnab, things were a lot different. But the tyre industry was the first to actually recover within the entire larger Motown arena. What is it that you're seeing on ground now as to how FY22 is likely to pan out?
Yes, the tyre industry, in fact, recovered quite fast, right, in the Q2 of last financial year. And the growth rate has continued strongly in Q3 and Q4. We expect a similar kind of momentum in the next financial year. Of course, Q1 will be an optical growth because Q1 last year was a washout. But we expect to have strong performance across replacement market, OEM market, and also pick up in international business as far as top line growth is concerned. For CEAT particularly, it is an opportune moment because we have been investing close to 4,000 crores over the last couple of years. Not all of that investment is complete, but we have caught the upcycle in a very opportune time, and we expect to have significant operating leverage in the coming quarters.
Exactly what I wanted to chat about. Can the upcoming CV cycle drive demand for OEMs for tyres? As MHCV as well as LCV tyres contribute to about almost 40% of your OEM sales.
Yes, it's a cyclical industry, and you can see clear cycles if you study the ups and downs over the last 25 years. I'm talking of the OEMs. So right now we are probably entering an upcycle. For the last 3-4 months, demand has been good and increasing. So our supplies to OEMs are certainly going to see an uptick. In the replacement market, the demand was already very strong and right through the end of first quarter, because transportation and wheels are basic drivers of the economy. You cannot, if the wheels stop rolling on the roads, the economy comes to a standstill and vice versa. So replacement demand is very strong, and the government's Atmanirbhar policy has also helped because more demand was available for the domestic manufacturers who are well equipped quality-wise and capacity-wise to tap that demand. So replacement and OEM both, we are going to see good demand and increasing demand over the next financial year.
Morning, Nikunj Dalmia also joining in. How exactly one should understand the impact of raw material prices for a B2B business or a quasi B2B business like tyre? Can you pass on all the raw material hike to your customers?
Yeah, so we have actually a significant amount of business in B2C, which is the replacement market. Which is like any competitive marketplace. We can pass on provided the competitive intensity allows us to. So that's one. The B2B part where we supply to OEMs, usually our pricing is indexed. A large part of the pricing is indexed to publicly available data of raw material. So that goes as per the indexation, and we go up or down as the raw material changes.
Could there be a situation where your top line becomes higher because raw material prices, if they go higher, it will add to your top line, but at the bottom line, because your working capital requirement will go higher, your fund requirement will go higher, the bottom line may not increase in that same proportion?
Well, when I talked earlier about top-line growth, I was talking of volume growth, actually. The value growth is a consequence of various factors like mix and price increase because of raw material, etc. So when we say that we see for CEAT demand is bullish, then I was talking of volume growth absolutely across the categories. And particularly for CEAT, there has been a continued increase in market share in replacement in all categories, minimum 2%. In passenger category, we are growing by 3 to 5%. So that's volume growth. Now, coming to your second question about margins. Yes, when raw material goes up, sometimes the price increases, lags a little bit the raw material price hike, but it actually is implemented from time to time. For example, if you want to have a sense, the March raw material situation is at least about 10% higher than the quarter 3 raw material situation, right? So to nullify that, we would require a 6% kind of price increase. So as we speak, about 4 to 5% of that increases happen, but there'll be a slight lag for the balance 1 to 2% pricing increase, which we are contemplating right now in early April. And through the quarter 1, again, raw material will further increase on the quarter 4 base, so which will require another 2-3% price hike, which we are planning to take through quarter 1.
How dynamic are your contracts, both from your suppliers, which is raw material providers, and your buyers, which is OEM buyers? How frequently could you assess them? I would have not asked this question, but when I look at the way raw material prices have gone up, I speak to few of your peer companies and few family friends. They are telling me that on the raw material prices, there are some raw materials which are 50 to 60%, which is getting unbearable. So how dynamic are you about renegotiating your contracts?
The usual frequency is once a quarter on both sides, on the buyer side and on the supplier side. But if there are situations where the spike is too high in a short span of time, then we sometimes look at a smaller time frame also. But the usual default time frame is once a quarter.
Okay. While we are talking about replacement demand, if I may add that for last year, which is the calendar financial year gone by, we've gone through a lockdown process followed by semi-lockdown, which means a lot of cars and a lot of trucks and a lot of vehicles have not done the normal motoring and commuting which they would have done. Could that have an impact on a replacement demand? Because replacement demand is also a function of wear and tear, and because of what happened last year, the wear and tear was much below the normal.
Yeah, see, what happened is that there were a lot of, let's say, tires coming up for replacement by March end. All that stopped. There was no replacement of those tires through the month of April and most of May. In June, it started looking up. So that natural pent-up demand came up. Then trucks were plying on the road. If you look back in April, May, and June, the trucks were not standstill. Yes, there was a moment where it crashed to about maybe 30-40% of the usual traffic, but it moved up to 60-70% pretty quickly, right? So the truck tire demand, the truck tire wear and tear went on. Immediately post the pandemic hit, the shared mobility industry suffered. So people started using their cars, which were lying in the garages, much more frequently than they've ever used in the past. People started shunning public transport. And this is not of cities like Mumbai and Delhi. This is also about small towns. And if you would venture out to the highways, you will see people using their motorcycles also to commute distances of 50-60 kilometers instead of the state transport bus, which they would have otherwise taken. So the switch is there, which is at least semi-permanent to permanent. I don't know whether we'll bounce back to using shared mobility and public transport in the future. So actually the wear and tear has gone up. Second, the next factor, of course, is the stop or the vacation of the imported tires, which is the Atmanirbhar Bharat initiative of the government. That has also made available a larger slice of the pie to us. So therefore, we are looking at a higher demand by way of consumer pull as well as because of import substitution.
Okay. Fair enough. So given what you've described, and with investments done in both capacity and products last couple of years, market share then going forward, how do you see that expanding, the kind of targets that you're working with?
As I had mentioned earlier, we have gained market share in the last financial year in replacement market and OEM market. And we are pretty bullish about holding and gaining market share in all categories, starting from two-wheelers to passenger car tires to truck tires. We have capacity, our products are stabilized. We have gained in network share, which is the share of quality dealers which are also dealing in CEAT. CEAT has the deepest penetration of the hinterland of India by way of a unique distribution model, which is somewhat similar to the FMCG distribution model, though not in scale. We reach the largest number of outlets and we are better than competition by 6 to 7x in terms of direct reach of outlets. So we think that we have the ability to tap the demand. And by way of creation of demand, we have been investing heavily in above the line as well as digital marketing. We are looking at consumer journeys afresh, and the world is changing. The old model of just advertising and picking up demand through your network is shifting to more mass personalization, customization of engagement with the customer. So all those initiatives are there. The products are good. The capacities are coming up. We are looking forward with a lot of excitement in the next 2 to 3 years, because when you talk about market share and investments and the operating leverage, you don't talk about the one quarter and the next. We are talking about the next 2 to 3 years.
Got it. Mr. Banerjee, we'll leave it there. Thanks so much for joining us this morning. Good chatting with you.
Thank you very much.
And getting a sense of how things are looking right now.